Hey everyone, welcome back to Corporate Decoder. Herbalife Limited HLF just filed an 8K reporting a material definitive agreement and other events, and I am seeing a significant refinancing that reshapes their debt structure. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just issued a massive amount of new debt and amended their credit facility, which has some interesting implications for how they operate. So Herbalife Limited, otherwise known by its ticker HLF, filed a report called an 8. Think of this like a company giving the public a heads up about really important stuff that is happening right now, not a regular earnings report. The biggest news here is about money, specifically a huge refinancing of their debt. On the 29th of April 2026, Herbalife, through two of its subsidiaries, HLF Financing and Herbalife International, Inc., announced the issuance of $800 million in new senior secured notes. These notes are due in 2033 and carry an interest rate of 7.750%. This is a pretty big chunk of change, and it means the company is taking on a lot more long-term debt. They sold these notes to big institutional investors, which is fairly standard for this kind of deal. This means they'll be paying interest twice a year in May and November, with the first payment happening in November of 2026. The total amount they owe for these notes is $800 million, and they have until May of 2033 to pay it all back. This new debt is secured by certain assets, meaning if they can't pay it back, the lenders can take those specific assets. Now, one thing that is really important when companies take on new debt is understanding when and how they can pay it back early. Here, Herbalife has the option to buy back these notes before May of 2029. But if they do, they'll have to pay back the original amount plus an extra fee called a Make-Whole Premium. This premium is basically a way to compensate the bondholders for not getting their expected interest payments over the full term. It is a common feature in these kinds of agreements designed to protect the investors. The filing also lays out specific redemption prices if they decide to pay off the notes sometime after May of 2029. So for example, if they pay it off in 2029, they'll pay a premium of 103.875%. As you move closer to the maturity date in 2031 and beyond, that premium drops down to 100%, meaning they just pay back the original amount plus any accrued interest. This gives them flexibility, but also a clear cost structure if they want to refinance or pay down debt sooner. Another key point in these agreements is what happens if the company changes hands, if there is a change of control event. Basically, if another company takes over or a significant portion of the business is sold, the note holders have the right to demand their money back early. They'll get paid 101% of the principal amount, plus any interest that is due. This is a protective clause for the investors, ensuring they aren't forced to hold debt in a company under new, potentially less favorable ownership. On the same day, the 29th of April 2026, Herbalife also entered into a 9th amendment to its existing credit agreement. This is essentially updating their main bank loan that they have. This amendment is pretty significant because it refinances and replaces their old credit facilities with two new ones. They've replaced their old credit lines with a term of facility totaling $225 million and a revolving credit facility of $425 million. This refinancing is happening alongside the bond issuance we just talked about, and the company is calling all of these moves together the refinancings. This is a major overhaul of their borrowing arrangements. The interest rates on these new bank loans are variable. They depend on something called the company's total leverage ratio. If the leverage ratio is higher, the interest rate will be higher, and if it is lower, the rate will be lower. It's either based on a rate called term SOFR plus a margin, or a base rate plus a margin. This means their borrowing costs can go up or down depending on their financial performance. The loans have multiple maturity dates, which is a bit complex. The primary maturity date is the 29th of April 2031. However, there are other conditions that could trigger earlier maturity dates. For instance, if certain convertible notes or other senior notes exceed specific outstanding amounts and the company breaches certain leverage ratios, the loans could become due much sooner, in December of 2027 or 2028. This adds a layer of complexity and potential risk if the company's financial situation deteriorates. This is where it all comes together. Herbalife used the money from these new refinancings, along with some of their own cash, to pay off two significant debts. Their old-term Loan B facility, which had a balance of $365 million. And importantly, they fully redeemed their $800 million in 12.250% senior secured notes that were due in 2029. This means they've retired a very high interest debt, the 12.250% notes, and replaced it with the new notes at 7.750%. This is a significant move to lower their interest expenses. To make this happen, they had actually issued a conditional notice to redeem those older, higher interest notes back on the 14th of April. This redemption was contingent on them successfully completing new debt financing, which they did with the new bond issuance and credit facility amendment. The closing of the new offering on the 29th of April satisfied that condition, allowing them to pay off those expensive 2029 notes. Paying off those 2029 secured notes cost them about $852.8 million. This price included the principal amount plus a premium of 106.125% and any accrued interest. This was a substantial amount to retire that debt, but it makes sense given the high interest rate they were paying on those notes. The company also put out a press release to announce all these refinancing activities. This is standard practice to keep investors informed about major financial maneuvers like this. Looking at this refinancing, Herbalife is making a strategic move to lower its interest costs. They are replacing an older, very high interest debt at 12.250% with new debt that comes in at 7.750%. This should save them a significant amount of money on interest payments each year. Historically, companies do this when interest rates are favorable or when they want to improve their financial flexibility. Given the current market, it seems Herbalife saw an opportunity to lock in lower borrowing costs for a longer period. However, this isn't without its risks. They've taken on a lot of new debt, increasing their overall leverage. While the interest rate is lower, the total amount of debt is substantial. The new credit facility also has covenants, which are essentially rules the company must follow, tied to leverage ratios and other financial metrics. If they fail to meet these, it could trigger earlier loan maturities or other penalties. Investors will want to watch closely how they manage this increased debt load and how well they stick to those financial covenants. The big picture here is that Herbalife is actively managing its balance sheet, aiming to reduce its cost of capital. The question is whether this aggressive refinancing will set them up for future growth or saddle them with too much debt. A comparable situation might be companies like Bed Bath & Beyond or Tupperware in their later years, which also took on significant debt, though in their cases it preceded major operational struggles. In Herbalife's case, the debt reduction and interest rate decrease is a positive sign, but the overall leverage increase is something to monitor. Right before we sign off, the research tools I use to dig into filings like this are linked in the description below. That is my take. Stay decoded if this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.